Hey, what's going on, everybody? Welcome back to another video. In today's video, we're going to look at de-risking the portfolio. We've got a lot of volatility back in the market here. I've seen a lot of people talk about de-risking and taking some defensive positioning in their own portfolios. Go over some options, and some of them actually might surprise you guys. But as always, guys, nothing here is financial advice. I'm not a financial advisor. If you go ahead and hit that like button, I would really appreciate that. So, guys, here's just a basic outlook of the stock market over the last couple months. You guys can just see these giant swings that have been going on. There's been a lot of volatility for a lot of different reasons. We just had a decent little buying opportunity with a dip down here in the S&P 500 down to about 6,700. The S&P's been having trouble breaking that 7,000 wall, but we've gotten close. We've gotten pretty close a few times, but as I said, you guys could see the chart here. And in fact, these types of swings are not the worst thing when we are invested into high yield covered call funds, because the market's trading a bit lower or sideways. We're still collecting that income and those premiums. But I'm going to go over a couple of different options that investors might take a look at as far as trying to de-risk some volatility within their own portfolio. Some of them are pretty obvious, and then some of them might surprise you guys, actually. But as far as my own portfolio goes, guys, here is my top performing as far as total return, ranked from the very top to the very bottom. So obviously HDIV is going to be on the list. This is going to be pretty defensive. We've got a lot of Canadian blue chip stocks in here, got a lot of banking and financials in there as well. And then, of course, you do get a mix of some US tech. And currently, HDIV is actually sitting below a 10% yield. So, with a fund like HDIV from Hamilton ETFs, you also have that long-term track record of dividend growth over time. So that is also a nice feature. Canoe EIT, of course, although this one is currently yielding about 7%. So it's pretty low yield for investors who are looking for high income. There's also ENCC and ENCL from Global X, which is the oil and gas covered call ETFs that they have. This one's been doing pretty good. Year to date, it's been starting to come back. They did slash the dividend down just by a penny. I think it was over a year ago now. So, maybe there's a chance we see a slight bump up on this one. The share price has been slowly climbing back. And then, of course, guys, there's going to be stuff like CDAY from Hamilton ETFs as well. But as you probably can notice from my own portfolio, my worst performing stuff is my highly concentrated technology stuff like QDAY, HHIS, and then, of course, anything crypto related lately has been a little bit down over the last little while, right? So let's go ahead and jump into some different options that we have, guys. As I said, HDIV, kind of a no-brainer from Hamilton ETFs. It's a core anchor within my own portfolio here, and I do really like that fund as a core holding. There's also CDAY. So if you want access to blue chip Canadian dividend companies with high income, I believe that yield is like somewhere around 17-18%. But basically, guys, you're getting 100% exposure to the CMVP Hamilton's Champion Dividend Index, and then you're getting they use leverage, and they use that leverage to write options on the S&P 500. So basically, guys, here's a snapshot of what you're getting exposure to. All the big blue chip Canadian names, you guys can see them here. Loblaws, Intact, RBC, Sun Life, Enbridge, all the rest that are there. Some of their holdings here: Fortis, BCE, Agnico Eagle Mines, Bank of Nova Scotia, a lot of banks and stuff like that you would expect within Canadian markets, Waste Connections, some defensive stuff in there as well. And, the same could be said as well for SDAY, blue chip American dividend holdings. So it's the same thing. This is the holdings that they use SMVP. And then they utilize leverage on this fund to write options to get you a high income distribution. But you guys can see the big ones here: Walmart, IBM, Coca-Cola, Exxon, McDonald's, Eli Lilly, Chevron, all the big players here that we can see. So those are some great choices from Hamilton ETFs, guys. I think personally for me, my first pick would probably be HDIV because you kind of get a fund of funds. You get a little bit of everything. HYLD, of course, is fine too. But, if we look at HYLD, and I've been holding it for quite a while, it just recently, the last while has been lagging behind HDIV just because of what's been going with the market, this Iran stuff with the US, all these kinds of global incidents and things that are happening, trade wars, tariffs, all this stuff, right? So, we're seeing people go into gold, we're seeing people go into the more defensive sectors like we talked about. So next up, there's also another one, ECHI from 9 Point ETFs. This one could be good too if you're looking for Canadian blue chip stocks. It's kind of an all-in-one. They put them all together here, and they use their covered call option. So the all-in-one invests in all the individual 9 Point shares, ETFs. ECHI, this provides investors with diversified exposure across multiple leading Canadian companies and sectors. And then they use their option strategy to generate monthly income. So this is kind of like a fund of funds as well. This one's been gaining some traction too. Personally, just my own opinion here, guys, I prefer CDA. I like Hamilton ETFs. I just like their strategy. They use those 0 DTE calls, and they're also giving you, basically 100% exposure to those blue chip stocks rather than selling a lot of the upside off. HHIC, I would say, is similar to the ECHI. And if we actually look and compare them, ECHI, let's go back a year, is up 22.7% just in share price alone, not including dividends. And if we take a look at HHIC, let's see, where did HHIC go? Oh, I've got it on my list here. So yeah, they're pretty close. I think once the total return details come out, that'd be a good comparison with those two. But HHIC, obviously managed by Harvest ETF, so you do get that great fund management as well. But both of them good choices with some defensive stocks in there. BMAX from Brompton ETFs as well, Brompton Funds. This one also has a track record of raising their distribution as well with a great diversified portfolio. You can see they've got about 80% in North America, 20% in Europe, and they've got a bit in Asia as well, but they've got their hands in a little bit of everything here, guys. Technology, financials, global infrastructure. They've got the global dividend growth ETF. So you get a good mixture of everything. Again, these are not going to be the most highest yield funds, stuff like HHIS, but as far as trying to lower that risk and that volatility, if we look at BMAX, over the last year, they are also up 7% in share price. Now, I know, we're not looking at total returns here, including distributions, but when we're looking at volatility pricing on your portfolio, it is one metric to look at. Some people have leveraged their own portfolios. So, if you have taken margin against your own portfolio, and let's say you have something like Biggie, well, you would be down about 19% on your share price over the last year. And that could affect, your margin requirements potentially, depending on how much you're reinvesting or how much you're putting in every month, right? So these types of funds will have a lower yield typically, but, you will maintain that share price value as well as steady distributions. GDV, the Global Dividend Split Fund from Brompton as well, would be something good to look at. It is trading pretty high though now. The yield is down below 10%. I actually held this fund for quite a while. Interesting note about this fund, all of their distributions are declared as ROC. So, if you're looking for something like that for tax purposes, they've got that steady 10 cents per month payment that they pay out. And as far as I know, they have never missed a payment. So that's another good option to look at. And then, guys, Harvest ETFs, not the high income shares, but just the regular ETFs, has some other great options. They just recently, like at the beginning of the year, increased a bunch of distributions on their funds: HBF, HTA, HUTL, HDIF went up, HLIF went up. You guys can see here, with this little arrow on the side, they actually increased a lot of their distributions. Now, HTA is a concentrated technology fund, and they actually have a leverage version, HTAE. So, you're going to see some volatility with this one as well. If we'll take a quick look into HTA, see what it's trading for right now. So, over the last year, it's up about 2.5% on share price, which is not bad. But again, you're still concentrated on technology, but it is over. It's close to 11% yield right now. Huge AUM on this one, 720 million. And then the impressive thing about this fund that I like to check out here, guys, is those dividends. You can see them. They went from 14 up to 16, but as we go back, you guys can see they have increased and increased and increased over time. And this fund actually has only ever increased the distributions. So, these types of funds that we kind of just went over, you're not going to get the highest yield compared to like an HHIS, but you can still get high yield and de-risk your volatility within your portfolio if that's what you're looking for. Of course, if you don't care about that, then maybe there's some good opportunities in technology and cryptocurrency right now. Stuff like HHIS, Biggie, even QDay. QDay's coming back up today, but QDay is still below my own cost basis. So I'm actually going to be buying some more QDay this week. But yeah, guys, this is kind of just an overview of the market recently and some choices if you are looking to smooth out some volatility in your portfolio. Obviously, guys, that typically comes with a sacrifice of some higher yields. But I think, yields of 10+% are still really good. I know that, the market's been changing these days. We're seeing all these higher yield funds, 20, 30+%. But I think if you can get 10 to 15% yield on some of these funds, and even HDIV, guys, here's HDIV in my own portfolio. Well, it's showing the current dividend yield of about 10%. But if you look down below under income, my dividend yield on cost is 12.61%. So when we think about blue chip dividend stocks, back in the days, people would buy dividend stocks and they'd hold them for 20 years. And, maybe your yield was 3 or 4% when you bought it, but 20 years down the road, you're probably at, a 30% yield or something like that. If you kept reinvesting those shares, you're going to be even a better return than that, because as those dividends increase over time, as those companies, report their profits and things like that, and those dividends continue to climb, hopefully your yield on cost will go up. So this is just an example with HDIV raising those distributions, right, guys? And I think CDAY is actually the same thing because it's had a couple of dividend increases. So the calculated yield on CDAY right now is about 17%, but my yield on cost is 18.5%. So, again, this is holding those blue chip dividends. I haven't actually held this fund too long. So CDAY, because they do use options and stuff, you're going to see some more volatility and with those payouts. But it's just a small snapshot of, time in the market versus timing the market, as they always say. And, guys, HYLD is the same thing. HYLD, it is going to be a bit more volatile right now because of everything going on that we talked about. But you look at the current yield, it's close to 13%, and my yield on cost is over 13% on HYLD. So it does help to hold these funds, even if you're buying now something higher yield like HHIS. If you're planning to hold it for the long run and you're not worried about the current volatility, you don't have a lot of margin against your account, or you can't handle those big swings, then maybe it is a good time to buy. But if you're worried about any of those things, guys, here's just some options. There's a lot more out there than these, but I just feel that these are some of the better ones to consider looking at right now. Let me know your thoughts in the comments down below, guys. I hope everybody out there is having a great week, and I'll catch you guys in the next video.